Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, June 9th, 2022. It is 10:24 a.m. Eastern Time as I'm starting the video, and what I want to do in this one is go over the major stock indexes. I'm catching up today after being out of town all week, catching up on the charts, and I will do updates on all the other trade ideas I've been highlighting recently, energy stocks, gold, silver, the dollar, Bitcoin. And then I mentioned, I got that one out to you the other day. I was working off my cell phone. I was in the middle of a presentation on my son's orientation for college, and just had those price alerts go off. So I got you. I'll do an update on PGJ, the Chinese ETF, and now also I started to go through the components there, like companies like Alibaba and the likes of those. So I'm gonna go through there and see if we can sniff out any individual trade ideas there. All right, but let me give you my thoughts on. I'm going to go over. Well, I've already shared my thoughts. You know my thoughts. I remain bullish, looking for a little more upside on the equity markets in the coming weeks or so. We've been going through a period of consolidation, as I mentioned this morning, perfectly normal. I'm going to get to that, tell you why we've been consolidating, or and what to look for going forward, most importantly. And I'll also point out, as I mentioned, as I like to always say, any point in time, just about, you give me any security, stock, bond, index, commodity, and I can make a bullish or bearish case. Just like in high school, the debate team, here's your topic, you take one side, and the other team takes the other, and you got to make your case. Well, there are certainly, again, at any point in time, I can make a case to be long or short something if I look hard enough. I'm always going to give you my opinion, and I'll always try to gauge how strong that opinion is. And what I'll do is I'm going to show you levels to watch, because there's certainly a case to be made. Number one, that A, this is a bear market rally only, and two, that there's probably going to be more downside. But number one, that maybe isn't the case. And or maybe the downside will start from here. Let me just go over the charts again, give you my take, levels to watch, and where I will pivot on my near term, what I call near term bullish bias, which is in the coming weeks. Let's just say I'm not going to give you exact, because it's hard to say whether that's going to be 3 weeks and 2 days or 2 months, or but for now, again, there's some targets that I still have on QQQ that I've laid out weeks ago. Actually, one more target and one potential, but one more final target, T4, on that 60-minute chart that hasn't been hit. But let me start out here, guys. Let me start with the longest term, big picture, kind of to recap, but as well as for those that are new to the site. This is something back a few months ago I was covering quite a bit. And if you were subscriber to the site then, I was persistently and consistently bearish, making the case, just checking the boxes one by one, and highlighting objective short entries both on breaks of support and bounces back to resistance. So we had numerous short entries, mainly on the shorter term time frame, 60-minute daily charts, even the weekly charts, and then I would use this QQQ monthly chart, which I'm going to do now, as well as the S&P 500, to paint the bigger picture and kind of give you that roadmap of where are we now kind of thing. Okay, I don't want to spend too much time on this, but again, for those not familiar with this chart, let me squeeze this down a little and just focus on price here real quick. These indicators. All right, this is QQQ, the NASDAQ 100 tracking ETF. And this spans back. This is a monthly chart. You can see up in the upper left-hand corner, if I don't make mention of which time frame I'm talking about. What that means is every candlestick represents 1 month of trading history. So when you want to go back for years, if not decades, this is a good chart to use, especially when you're viewing decades. So we're going back into the early 90s here. And you can see over time we had a great bull market back then, especially in the tech-heavy NASDAQ composite and NASDAQ 100. And there was our bull market uptrend line. Then things started going in the late 90s near parabolic. We had a nice, pretty steep, strong advance, and it got even just crazy, kind of blow off top there. And we all know what happened. So these were just corrections along the way up, and that's the nature of the beast. And then the bear market came, and the NASDAQ 100, which remember these are the most stable or at least the largest of the 100 largest companies in the Nasdaq Composite. The Composite, I believe, would have felt worse. You have a lot of dot coms. A lot of the dot coms that went bust back then were the companies without any earnings, any sound business plan. They just had the name .com behind them, and that's where it got that pop. But it brought the big names down with it, and that's one thing that people, and it just never fails to amaze me in this day and age with these great business schools out there and these analysts coming out of these schools. They just don't get it. Is that the baby gets thrown out with the bathwater in a bear market? And I've watched for months now these analysts coming on TV and just defending their price targets on Apple and Amazon and Facebook and all these, well before they dropped a lot of those stocks, 50% or more, and not understanding that fundamentals, well, can and will change, and that's often you're not going to get it off the balance sheet or the guidance unless it's the turn has already come. Guidance is always rosy at the top, the balance sheet, the earnings, the fundamentals are strong. Technicals will warn of the top and the change, much better predictor. And then the tide changes. And then also, more importantly, is that the stock market, it's like the tides in the ocean. You have rising tides and all ships are lifted in a rising tide. And when the tide changes, things go the other way. Okay, so that's what happened there. And here's what I wanted to show you. I'm not going to spend too much time rambling about that, but that's important to understand that technicals are a much more accurate predictor, especially for timing and calling. It's great. It's easy to be a bull in a bull market, and it's also easy to be, if you're going to be over the span of your life, a bull or a bear. Better to be in perma, either one, perma bull or perma bear. Obviously better perma bull because the market goes up more than it rises. However, those flexible traders like myself that are just as comfortable being short as long and able to recognize those turns and recognize what's probably the beginning of a longer trend can not only sidestep huge losses but can turn around and profit from that. So that's what this site's all about. That's what technical analysis, swing and trend trading is. And that whole malarkey, because you hear it time and time again on the media on TV. You can't time the market, it's time in the market. I used to be a stockbroker, and that was the first cliche they told us to tell our clients. And look, it is true. It takes a tremendous skill set to time the market. I will tell you that now. I've spent my life, better part of my life learning that, and to this day I'm far from perfect, but I learn, and I continue to look for new things and find out where I'm wrong and see what it was that what I missed when I missed a call and I was bullish when I should have been bearish. And again, so that's remember, it's a journey, not a destination. It's perfection in trading. But again, my point is, this is what we're all about here. And so this is one of my favorite charts to look for the big picture. And the two things here, well, of course, there's trend lines, which I put a big weighting on. I use a lot of price support and resistance levels and trend lines in my analysis. There was our primary trend line there, but there was our secondary steep up trend line that broke, and that triggered the drop there. And then you set up, this was our next bull market. After that 84% bear market, you had a bull market here. These numbers only measure the corrections, just you kind of get a scope for how much the NASDAQ 100 drops. And this was our this is currently our bull market uptrend line. So I just want to say, as I'm zooming in now, I am of the mindset, and I've maintained this, that we are still in, that all these drops here, 26%, there was a flash crash, then it took the Qs down, QQQ down 26, not the NASDAQ 100. But remember, you don't trade the NASDAQ 100. If you're trading QQQ, you lost from high to low 26% during that flash crash, because it was actual and it was real, and that's where the prints traded, and that's where the stops would have been hit. So there was a 24% drop the fourth quarter 18. Again, I'm measuring high to low. 31% when COVID hit. They were just simply, although the media might assign, media still uses what I consider antiquated definition of a drop of 20% or more, a bear market. Well, to me, every index, every security, every commodity is different. And if you apply the old antiquated 20% drop from high to low, or high off the highs as a bear market, to something like natural gas, and guess what? Natural gas is going to have a bear market about every month or so, because that's the nature of that beast. It's so volatile. The trends are, it goes up 30% 30, 40, 50, 60% in a matter of months, and then it turns around and drops 20, 30, 40, 50%. So those are just the corrections, if you will, a drop, 20%. And in the NASDAQ 100 is more volatile than the S&P. It has a higher growth component and more growth stocks, so it tends to go up more in a bull market and tends to fall more in a correction. So just want to set that in again, if you're new to the site, so you know my take is this is our primary bull market uptrend line. And also my take is that this is one of, if not, I don't know the statistics offhand, but it may be considered the largest, the most powerful bull market in history. Again, if you measure it from where I am, the 2008-09 lows right there in the NASDAQ 100, that is certainly one of, if not the most powerful bull market in history. And it is, you can't use words like solely or exclusively. I don't really try to get away from the words always or never or all or none, but largely attributed to the Fed's easy money policies. Remember, I've showed you charts where we've been in a secular bear market in interest rates since the early 80s, where rates have been falling, and they have now nowhere to go but up. They can stay down, but they have, from where they hit the bottom, they can't go any lower. The Fed took it to zero, and so we're most likely, in my opinion, in the very, very infancy, early stages of a new secular bear market. But the thing about it is, this bear market, remember the Great Recession? We peaked in October of 07, bottom in March of 09. Every other index but the NASDAQ 100. NASDAQ 100 bottomed technically in November of 08. The S&P 500, mid caps, small caps, they all bottomed in March of 09. And that was a 55% drop roughly in both the NASDAQ 100 and S&P 500. You only saw the S&P drop as much as the NASDAQ in that bear market because the banking sector virtually collapsed and the government had to bail them out. You don't have financials in the NASDAQ 100, but you had a heavy weighting back then in the S&P 500. Otherwise, normally in bear markets, the S&P does not go down as much as the NASDAQ. It didn't drop nearly as much as 84% that the NASDAQ 100 did back in 2000 to 2002 there. And nor have these other corrections as much. Although, yes, in COVID, you had about a 36% drop in the S&P, and that's, again, had a lot of financials and other travel stocks and things like that, hospitality and that kind of stuff dropped hard. All right, but here's the big picture, guys. We have two indicators on here. One indicator, I should say, is one of my favorites. I've harped on this many times. I give it a 10 on a scale 1 to 10, and that rating includes both accuracy of that trend indicator, but factoring in the simplicity. And what I mean by that is it's a single moving average. It's a 20-month exponential moving average, 20 period on a monthly chart. And it's so simple, and I encourage you to replicate it on your own charts. Number one, make sure you use log scaling. If you're not using log scaling on a monthly chart of something like the QQQ, you're just looking at a whole different animal, because it's not going to show you the moves in percentage terms. So it looks like this one parabolic giant blow off top. Now, it's been a strong advance, but this, by putting it back into log scaling, which I just did, puts all these moves in equal percentage terms, if that makes sense. Okay, so you had a 55% drop there, you had an 84%, more, almost double. But when you take off log scaling, in a lot of charts, they don't default to log scaling, they default to arithmetic, aka linear scaling. So do that. Put up the 20-month, and then you'll just look and see how a phenomenal job it does defining bull and bear markets. Like back then in the dot-com bubble, here in the great bull of the mid-early 90s all the way up to 2000, it was support. You buy pullbacks to that 20-month. You tagged it there perfectly. You hit it there. You hit it there. You hit it there, and then you finally took it out. There was your breakdown candle. And it's a monthly chart, so you wait for a closing monthly candle. Doesn't matter what happens intra-month, only how it closes. And that said, hey, the trend has changed. We're no longer in a bull market. Even if you waited to the very end of the month, and you could have seen as the month was coming to a close, there was almost no way it was going to recover. So you could have got out of your 401k early, not waited. But let's just say you waited to the very last day of the month. I'm going to grab the body of that candle, where it closed. From that point, you averted another 69% drop in the NASDAQ 100 by simply using this indicator. And then if you wanted to know when it was safe to get back in the water, well, there's your monthly close above. And if you took that, well, I got to go back here now. That was you captured almost all of that next bull market that went all the way to the top in '07. And again, it got you out there. So there is honestly, again, factoring in both simplicity and effectiveness. And again, dismiss intramonth breaks. You wait for a solid break. Even when COVID hit, you see we took it down intramonth, closed right back above it. And so no sales said 401k money, stay long. 401k money, stay long. You were above it. In fact, add, because you successfully back tested it. But then here, as I said, back in April, we printed a solid close after 3 months. 1, 2, stick save, 3, stick save, closing above it. We had a solid close above it in April. Said get out of Dodge, out of your tech stocks at least. And the next month we back tested it, failed, closed well below it, and we're still well below it. So this is my big picture. We are in a most likely, at least according to this indicator, early stage, what I believe to be bear market action. And however, you still have this primary long-term trend line. So by that metric, we're still in a bull market. But when we take this out, again, will have taken out a trend line that is 13, almost 13 and a half years long, and probably will be by the time we take it out. And that's going to indicate to me that some of my longer-term targets, targets that people, even those that have finally come around on, the pundits on the media that were bullish all up until recently, they'll acknowledge we're in a bear market. At most we might see, they probably have no idea how far this thing can go. But the thing is, I'm not trying to be doom and gloom. I think it'll play out much slower than the previous one. That bear market, the last true bear market, at least the one in my opinion we had, October of '07 to, we'll count the March low, which even, because technically, again, the NASDAQ bottom there, that was 1.1 years, and here it was 1.4 years. So it was less than 18 months. That one, as bad as it was, 55% drop, it was almost over before you knew it. This one I think is going to play out longer, and I see a lot of opportunities, even for you don't have to be, and if it plays out the way I think, won't have to be the most nimble trader. Again, this is what I try to do, tell you the levels where I think it's time to cover shorts, and I'll speak to the 401k investor, and I'll speak to the active trader, and I'll try to differentiate my analysis. But this is long-term stuff here. And I think there'll be plenty of bear market rallies, and even what you might want to call cyclical bull markets within a larger secular bear market. That's as of now, and I know things may not play out that way, but that's sort of what I'm looking at. So we play out this way, ultimately break that trend line, and these rallies, these counter trend rallies, will be well into the double digits and lasting usually months. And so therefore there's opportunities for even someone managing a 401k. Maybe when it's time, it looks like the bounce has run its course and the next leg down in a bear market's coming, move all your money into cash or cash and bonds, which usually will go up when stocks fall. And then when stocks hit that next support level and the charts are confirming a bounce is likely, that's where you can move some money, gain maybe a 20% bounce in the indexes, put your money in an index fund or whatever, make 20% over 4 months, 3 months. That's typical in a bear market easily, and get out. And you do that, and think about it. If you sat in cash all year and you happen to move in and gain a quick 15, 20, 25% bear market rally that lasted a few months, you get out. Well, you just had you vastly outperformed the average return on the S&P 500, and you grossly outperformed the actual market itself, which has been, again, if you're assuming it's in a bear market. So all right, that's where we're at, guys, and we are still, that's month number 1 was the close right there. Month number 2 was last month, May, and here we are in June. Potential target would be a back test of that level, but again, you don't, you can't nail the timing on this one as well. You don't, in other words, if this monthly candle hit that level, that's not where I would short. I'd be watching the 60-minute and daily charts, maybe the weeklies on where to close out any remaining longs I might have at the time and put on some swing shorts again, close out some 401k positions. I told you for the first time, in a while, I moved into when I covered all my shorts a few weeks ago and told you I was going to long. That's where I took in 401k money where you don't have a lot of options, moved money for the first time back into significant chunks of index funds, stock funds, small medium and large caps. All right. Oh, and that's it. So there's the trend line. However, and that's also first support. Remember, it was also my first support on the weekly chart on QQQ. I had 299 was my first, what's that, T2 on the weekly? We'll get to that in a minute. But I wanted to show you SPY. Remember, the NASDAQ 100 is not the stock market. There's, even the S&P isn't the stock market, but it's more representative of the overall stock market because you have 500 companies instead of 100. You also have 11 sectors that are more representative of the overall economy, not completely inclusive, but more representative, including financials, which you don't have pretty much. There's virtually a nil weighting in the NASDAQ 100. NASDAQ 100 is over 50% tech companies, and then you have a lot of biotech, high growth things. S&P again is a closer measure. You can use the Wilshire 5000. That's a very good gauge of the overall health of the stock market, but a lot of folks use the S&P 500. The Dow to me is antiquated. It's only 30 companies, and that's not going to be nearly as representative as the overall economy as 500 companies. All right, so there's my primary uptrend line in SPY, not as well defined as the one I have on QQQ. So let's focus here on that 20-month. The 20-month again does a great job. This was COVID, 36%. It told you, it gave you a sell signal, but we recovered it the very next month. We closed that candle right back above it. So even though it said, hey, get out, there's a bear market, the Fed, this is what I refer to as Ursa Interruptus. It's my rough Latin translation for a bear market that was interrupted. And so there would have been a lot more had the Fed not come in and fired off, hit the nuclear button, which they did, and that gave us that. And now they're having to take away that juice, and that's so far caused this. And as I myself and many others now believe a lot more to come, it's just how are we going to navigate that? You don't want to be short throughout a counter trend rally. And so far, from the bottom here in the S&P 500, if you did like I did and covered, you averted, just in the S&P a 9% bounce back. But on many of the things I've traded, like Amazon, the NASDAQ 100, you're talking closer, to about a 20% bounce so far. And, if you've got nerves of steel and unlimited funds and you're heavy short and you're going to remain short, great. Maybe that's it. Maybe we go down. I'm just showing you the levels to watch. This is the S&P 500 on that 20-month moving average, which again, go back in time, use your own chart. You can see it's done a phenomenal job of defining bull and bear trends. Again, when you're above it, trend is bullish. When you break it and you're below, the trend is bearish. You can short, for pretty much, or watch. It bounces back to it, act as resistance, and then boom, across it, you're in a bull trend. So there's all your bull and bear markets. Bull market, bear market, bull market, bear market. And then this is the great bull we've been in, and pullbacks to that level. There's been a few whipsaws. Nothing's perfect, but for the most part, any whipsaws you recovered the next month. So even if you were using this religiously for your 401k money, meaning long when it's above, short when you're below on a monthly closing basis, any whipsaws you had that shook you out of the market, number one, you can't short there anyways. You would just jump back in the following month and you would have captured 99% of this entire bull. You would have captured the majority of each bull and bear market, been out during the bears and during the bulls. And so that's what I'm watching, guys. I'm going to beat a dead horse here, but we had 1, 2, 3 weeks where we defended the 20-month on SPY. 4 actually, because we closed right on it last month following an intra-month break, and we're right on it right now. So this is where I'm going with this whole thing, is you can't write this off yet. I think we're going to take it out. It's just a matter of, do we do it this month or next or 3 months from now? And when we do, what does that tell me? Well, if you have that and the NASDAQ 100 both below with a solid monthly close, then it just helps to confirm or reaffirm my thesis or ongoing, take that we are in early stage bear market action with quite a bit more to come. Then, of course, watch those trend lines and price support. And as I've said all along, I'm still targeting my intermediate targets and maybe longer term targets. I'm still targeting what I call the pre-COVID highs in both the NASDAQ 100 and the S&P 500. So we still have a way to go. To me, it's a matter of, do we get a little more upside here? I'm not looking for a lot more, and I'm not married to it. Or is that it? Because we've hit my let's jump down to the weekly charts. Remember, we hit my second targets on the weekly charts on QQQ, SPY, IWM, all of them. And that was it right here. And we had a reaction so far. That's why I list multiple targets. The initial tag, there was the initial tag of T1. The initial tag of each of my target levels is somewhere, they were all laid out in advance. Somewhere where I think a reaction's likely. I define a reaction as when you're on the way down, a reaction's a bounce or a consolidation. This was a bounce. We hit it again. We consolidated around. We got a little both. Then we took it out. Once we took it out, clearly, we went down. We hit my next target. We consolidated on it for a couple weeks, traded around it, had a bounce so far. So there's your reaction. The $1,000,000 question is that it? Is that all we're going to get? And lately we've been consolidating. I still believe we'll probably get up another run up before we go down, but we could very well do that. Remember, I had this level right here, 415.51 is yellow because it was a very significant support level to me. I'm sorry, right here, 415.51. Support once broken becomes resistance. So we rallied right into it, smack into it, boom, hit it again. So if we can break it, that's probably going to give us a pretty sharp run up. Give you that chart this morning. There's our consolidation recently. See, we had the sharp run up. Some consolidation, and let me show you it on QQQ. Let's look at that. QQQ, you had the sharp move off the bottom, and we've been consolidating. I showed you on the daily chart as well. This is what it looks like on the daily chart. This is consolidation. So if you've been frustrated for the last week or so, and if you've been getting, especially if you've been getting whipped out, if you've been going long, short, you shouldn't be. This is noise. This is hard to trade. I'm almost glad that I wasn't in front of my desk for the last 3 days. I might have been tempted to try to, actively trade. This is, and maybe if I would have really focused on the 5 and 15, 10-minute charts and short-term charts, I might have been able to make some trades, but I also probably would have had some stop outs. Here's what I said recently. This is it was actually, let's see, this was right here, June 2nd. I put 2 posts in the comment sections that talking about, this is when Amazon hit my second target, and well in advance, before we even got there. If you're new to the site, I'm talking about, I went long. Amazon was one of my favorites off the lows. They had my long-term weekly support to the button, called it down to this level from the not the very highs, but shortly off the highs. Hit my level there. I posted as a long entry here and again here. Re-highlighted it. This is a 60-minute chart. And I made it clear before we even got there that I would not be selling at T1, that I was going to hold out, and T2 was my preferred intermediate target, or near-term target, and that's where that very night we hit it right here the second time around. I think that was here in the after-hour session. We made a full tag of my 126.23 target, and so I made it clear that yeah, there's a chance of another 7 to 10% more upside in Amazon, but the easy money has been made. And if it does manage another 7 to 10%, there will most likely be a lot more back and forth zigzagging from here in which to run stops or second guess a long position. So better fish to fry. So that's where I sold all my Amazon. Glad I did. And I may buy it back soon or maybe not. The other thing I said on that same very day, that was, again, June 2nd, right after the market closed, which, just look at that here, June 2nd after market close was right here. That, if I put my crosshairs there, that was June 2nd. That was the peak right there. And so, what I went on to say is, blah, blah, blah. We do have negative divergences forming on the 60-minute chart, so probably not a bad idea to book partial full profits here. I said we could hit T4, which I'll get to in a second on my 60-minute chart, but that's only 1% above where QQQ closed and was trading when I made this post, last week, almost a week ago. So I said, personally, I sold all the NQs, all of my NQs in my trading account, closed it out, sold all my shares of Amazon across multiple personal family accounts. Those are long term, those are swing positions. That's, again, because T2 was hit. And Amazon, remember, I know it's only one stock, but it is one of the most important stocks out there, hand bar none. Amazon right up there with Apple, and probably even more so for a gauge of the economic health. That's Amazon. People are buying and selling things online. Um, and so Amazon was one of the reasons, or one of the big reasons I posted the day I covered all swing short and trend short positions across all my accounts when Amazon hit that long-term target I had on the weekly chart. When I turned around and went long right after that. So where I'm going is, I also said I sold for the first time since reversing off those lows a few weeks ago, some but not all of my QLD, TQQQ, and those accounts, and so that was it. So the takeaway, guys, is the risk reward, a week or so ago wasn't nearly as attractive. In other words, what I said this morning, the easy money was made off those lows. The risk reward was the best I've seen in years when Amazon, as well as all those indexes, fell to those key support levels on the weekly charts, to the button. Nvidia hit my price target, same thing, long-term target to the button. And so that, to me, was the all-in moment, the heavy, using the margin. And now where we're at, like I said, book profits on a lot of longs. I did buy some back, as I mentioned in a follow-up post here recently. We pulled back to support, was it last week? But if I sound like I'm rambling, I'm just trying to convey, how I trade, and how you might consider that, when you have this run, if you didn't want to buy there, I said all the reasons why the risk reward was good, that hey, we could break those levels and go down, but the risk reward is attractive, meaning if you bought the Qs here, and if you bought Amazon, Nvidia here, and you put a stop just not too far below because they were at big support. So if they broke those support, that would be bearish. And that's why I talked about risk reward. So you were only risking a very small downside loss if wrong, compared to the upside potential. But when we got here and we hit my third target zone, and we've been trading on it, in consolidating, and like I said back then, at this point, T4 was only 1% above. Now, okay, so where am I going? Well, number one, that's it. So if it wasn't made clear enough, as I just reiterated, you should have expected that we weren't going to do this forever. Okay, that this was over. That was the easy money. That was when you look at the daily chart. It was a daily chart right here. It was, 3 straight big days of gains. We had a little consolidation, another big pop, and that was it. That's when the easy money made. That was when those posts were made, June 2nd right there. But we've been consolidating. Now, the way I look at this, too, is on this daily chart, I still see constructive technicals. I see the same case for going long here and covering shorts. Positive divergence. We had a downtrend line. We had a breakout candle there. All right, but what happened, it took some energy or spent fuel to get to that level, and so we've had some consolidation. This is where all the naysayers, those that didn't want to short here, even though all these reasons why you want, the risk reward was excellent, all the back tests of the 200-day moving averages that I posted here as objective shorts, those people that didn't want to short all of a sudden wanted to short here after the Nasdaq 100 fell 30%. Where I'm looking to cover because everyone else was starting to get bearish. So even though I'm not even looking at the sentiment indicators, I don't need to. Believe me, everywhere I go lately, I hear, even in FSU orientation, I hear comments about how the stock market's been, how bad it's been this year. And so everyone's cognizant of that now. Everyone's bearish. And again, so at least near term, that put me to bullish. And that's why one of many reasons why I still think there'll be a little more upside here. And potentially all the way up here. I remember this downtrend line. This is my max potential bounce target. That's subject to change. But I think there's and the longer you consolidate here, this is like a coiled spring. We're building energy. So if we can pop that level, what I think you have a lot of what I call JCL shorts, Johnny come lately shorts. They didn't want to short here. They wanted to short here, so they're buying SQQQ and QID or just shorting the Qs and all that. And if we pop up, they're going to be squeezed. Now, On the flip side, I spent months and months talking about all the bearish developments and how selling will beget more selling and forced margin call, and the hedge funds being way behind the curve here, overweighted in equities, and having so all that is still there and may come into play. So I'm not telling you definitively, nor, and most importantly, nor am I pressing the longs hard at this point in time. And on top of that, for the little position that I do have, I'm ready to flip on a dime if convinced to do so. And that'll be, I gave you some pullback levels, including this gap right here on the 60-minute chart. So QQQ. Remember, you had this bull flag right here, continuation pattern that was highlighted at the time. We broke above it, and there's that gap right there. They haven't backfilled or tested that gap. And so that's also a potential target. But we start taking out, if we go to backfill that gap, great. The buyer should step in. If they don't, that's where I start saying, wait, something else is going on. I'll extend this trend line as well. It's going to come around the same level. So this round right about here, and remember, 294 was a huge level for me. I used the word literally explosive rally, expect an explosive rally if that's taken out, and I also expect it to get taken out. So that was a big breakout for me there. So that is where we start taking out this, and then especially 294, that's it. I don't want to be long anymore. And then whatever. I milked most of the bounce, and then what positions I didn't book profits that I got back, I've been buying back here. This is good support, 305. If you look at it this way, you had a few pierces through here from about 305 down to about 302 right there. And then there's the gap just above it. This is where the market's been consolidating. So if you do believe there's going to be another thrust up, you want to buy at the bottom of this range with a stop somewhat below. And you can add on a breakout above the top of the range. The top of the range is not super well defined. I think I gave you a downtrend line today that may come into play. Again, it's not very well defined, so I'm leaving it off for now. But for the most part, I'm going to move this line up now. For the most part, I think a pop above 312 will do the trick. There was certainly that spike high there, but you can see here a lot of the recent highs came in around 312 or so. So look for that. And again, bearish if 305 is taken out, more bearish if 304 is taken out. And then if they do take those out, there's still some support there. That would be, I'll look at it this way. I always try to look at what the algos are doing, the market makers. That would be a beautiful little stop rate. If they can take it down there, I'm sure there's a cluster of stops on longs right around here. They could take those stops out and then come in and hit that trend line, step in and buy there. So again, I'm okay having some long position there. I'm not crazy uber long or anything like that. And that's where I start scaling out of what little longs I do have. And whether I immediately flip back into shorts or not, I'll let you know. Okay, it appears that my internet connection just went out. Thank you, Comcast, the worst cable company in the world, but you don't have many choices where I'm at. Let me check. So if I load another chart, let's see what happens here. Yeah. Okay, I can see from my other monitors and a little smart device on my desk. Internet's out, so I'm going to have to pause the video here. Hopefully it comes back online, or I'll tether on my cell phone and try to wrap the video up. Alright guys, you know what, I'm going to, instead of jumping on and tethering off my cell phone, which is my backup for my data connection, I'm just going to wrap up because I'm just going to show you the same thing. If SPY would have loaded, I'm showing you that's consolidating. One other thing fundamentally to look at besides the technical case I just made, that we could see some upside, and I believe so. A lot of things hitting divergent, positive divergence, I'm sorry, on many key stocks and sectors. Again, that's the case for rally. The counter to that is, remember that in a bear market, bullish divergences, bullish setups tend to either not play out for as much as they would normally play out for in a bull market, or even their measured target, when sometimes they don't play out at all. So you have to factor that in and kind of temper down. Normally, if I get bullish divergence on the daily time frame like we have now on many market leading FANG stocks and the indexes, that's where you go long, heavy long, 401k money, swing trading, trend trading, but that's not the case right now. You can be long from it, but again, you probably want to temper down your targets. The other thing I was going to mention, I already had this queued up. So the page, even though my internet's down, the page is still there until I refresh, then I'd lose it. Is the whole Tina argument. Remember, for the last, well, decade plus, really since 2008, the whole argument to buy stocks was Tina. There is no other alternative, right? Or there is no alternative, because the Fed. Intentionally, even going all the way back to the days of Bernanke, he stated it directly. It wasn't. This isn't some like theory that the Fed, one of the reasons they didn't bring rates down is to push money into the stock market by taking rates artificially low when investors and institutions, think hedge funds, pension plans, or pension funds, things like that, when they can no longer get the 5-7% yields that they used to get on CDs and treasury bonds, safe money investments, when they're looking at, especially in recent years, they were looking at under 1%, then that forces them to find returns elsewhere. And that's what forced a lot of, and again, it was a dangerous game the Fed played. They kept rates too low for too long. And so I still think we're going to see huge, and this is why I think this will be a long, long, drawn-out bear market when these pension funds start to, collapse, and then there's all this talk about government bailouts. Got to pay, and I get it too. You do. You have to pay the teachers and the firefighters and all the public employees. They were promised these pensions. They're going to retire, but they don't have a 401k. You either have a defined benefit plan or defined contribution plan, meaning a 401k. In recent decades, employers have shifted, especially in the private sector, away from pension plans where you retired and you were guaranteed X amount a month for the rest of your life, because that put the burden on the employer. Public sector still does that, and that's what those pensions are all about. And so, the taxpayers are going to be on the hook for it. And even then, the retirees are probably going to be looking at reduced benefits. It's going to be a big mess. It's going to be a hot mess. It's going to take a while, but that's part of what's going on. But here's where I'm going, guys. I know it sounds, again, like I'm rambling because I'm interjecting. I'm talking, my background in fundamental analysis, which is where I started, college, business major in college, and then financial advisor. Looking at the fundamentals and the technicals, marrying those together. So here's CD, right? I just went to bankrate.com. You can do the same. It doesn't matter what area. I just did my local zip code. You can do, and just glance the rate. These are the best rates out there on CDs from 1 to 5 years. And you're seeing right now, Capital One, if you lock your money up for 5 years, they'll give you 2.6. If you only want to lock it up for 2 years, you're going to get about 2%. So where am I going with this is, yes, have rates come up? Absolutely. You couldn't get probably 1% a year ago on a CD. Now you're getting 2, but we're not at that point. So we're still almost at a Tina kind of thing. There is no alternative, and maybe it's moved to a TASA, we'll call it. There are some alternatives, but we're not at the point. This is something I'm going to be watching. You guys know my outlook on bonds. I'm longer term bearish. I think we've entered a new secular bull market in rates. Rates will trick higher over time, but there's going to be ups and downs between there. And so I think when you start getting, and again, it's also going to be tied to the rate of inflation. Right now, the real rate of return is extremely and unusually low, with the Fed keeping rates artificially low. As much as they've done, they haven't done a fraction what they need to do. They should be, their interest rate policy, the federal funds rate should be closer in line to the rate of inflation. And it's so far from that right now. So what I'm trying to get at here is institutions are not moving. If they're taking money out of equities right now to protect their downside, they're not diving headfirst into treasuries, because treasuries are going to be right around what CDs. CDs are the risk-free rate of return. They're federally backed. And so they're going to give or take pay a little bit better than treasuries, but I could tell you that right now. So what you want to watch for is keep an eye on CD rates and treasury rates. And when you start seeing 4, 5, 6%, especially if inflation begins to abate, that's where you're going to see money getting siphoned out, gradually but incrementally moving out of the stock market into safe harbor fixed income investments, because there are a lot of people out there, especially retirees and including pension funds that are investing for those retirees, that will all day long take a fixed guaranteed 7% return on a CD or treasury bond over a maybe 8%, 9% historical average in the stock market. But with that average return in the stock market comes years where it drops as much as 50% or more, in years where it goes up 30% or more. And so that's what's going to ultimately be the death knell for this secular bull market, is if we continue, if inflation does not abate, if the Fed cannot get a handle on it. And myself and many others think they're too far behind the curve at this point to do it. The cat's out of the bag. It's not going to be a straight linear shot up. There'll be some abatements. The market's going to rally when it looks like inflation's abated. But just watch this and know this, that over time, look at the where interest rates are on safe harbor investments, especially relative to the rate of inflation, and that's when you're going to see it's going to put pressure on the stock market. But we're not there yet, and this is why I'm saying near term, I think we'll probably see some more upside. I think people are going to come in. The other headline I wanted to show you right here, and then I'll wrap this up, was this headline from the Wall Street Journal recently. Tech's decade of stock market dominance ends for now. When I see headlines like this, it makes me want to buy tech. This guy's coming out, whatever. I didn't even read the report, I'll be honest with you. But, after Facebook and Amazon dropped 50%, what good is that? It's not timely, and it's also almost contrarian, where it wants to make me buy those tech stocks. So I think there's going to be, maybe for next month, a couple months, the potential for more upside in the market. But I gave you the levels where I flip and recognize that I'm wrong, and that's not going to happen. And then I will, any remaining longs I have, get out of those, and or begin to re-enter some swing shorts for my next leg down on those next targets that I have on the weekly charts. All right, it's a long video anyway, so I'm almost good thing that I got cut off. My internet's still out, so we'll wrap it up here. You already have, just reference the old charts, old videos. You have my longer term weekly targets on QQQ and SPY, and you have the near term levels, which I started out with in this video. And at the end of the day, recognize and learn to recognize in advance, like I tried to lay out a week ago, when you're going to see this choppy market. So again, if you've been frustrated over the last few days, getting stopped out, not knowing whether to be long or short, well, that's one of the things I try to do, is predict when you're going to get in those grinds, and trading's going to be tough. So you either be patient or just shut down, go do something else. It's a great time. Like I said, it was almost a good thing that I was in front of the computer the last 3 days, because the market went nowhere, and if I would have ended up getting traderitis, I probably would have lost money. So I'm going to wrap it up here, get the video out to you guys, and I'll follow up with some more today. This has been Randy Finney with Right Side of the Chart. Have a good one.